This is the Capital Markets. Good evening and welcome to the program. I'm Edidiong Iwang. A federal high court sitting in Lagos has granted an order sanctioning the scheme of arrangement for the demutualization of the Nigerian Stock Exchange. Following the court order, the Chief Executive Officer of the NSE, Oscar Onyema, says the Stock Exchange plans to secure the re-registration of the NSE and the approval of the Securities and Exchange Commission in the coming months. Members of the NSE had approved the demutualization scheme of the exchange at an extraordinary general meeting in March 2017, and this was followed by the signing of the demutualization of the Nigerian Stock Exchange Bill into law in August 2018. The debt capital market this week received the revised bond auction calendar for the second quarter of the year from the Debt Management Office. The report indicates an additional 105 billion naira borrowing monthly in line with the revised borrowing plan of the federal government. This means a lot for capital market players, despite the scheduled auction for the month remaining unchanged at 60 billion naira. The Deputy Head of Investment at ICO Pensions, Tony Odutola, joins us now for a broad analysis of this development. Good evening, Tony. Thank you for joining us on the program.
Good evening, Edidiong. Thank you for having me.
So it would appear that the debt market had no clear direction for this week. Why is that?
You will appreciate that things are very fluid at this time. And so because you have new developments, and that necessarily means that the market players will need to understand where things are going. So in the immediate, you probably find that people will be a little wary of, jumping with both feet into the market. So yes, you can say things are not going as you would like to see, but really it's more of understanding what the environment is like.
Okay, so the Debt Management Office held a Nigerian Treasury bills auction on Wednesday. Now, that's a move that we don't see them carry out regularly. Was it as a result of the size of system liquidity?
Okay, when you say move, are you referring to the amount that was allocated?
On Wednesday, yeah.
Okay, so if you've watched at probably from the beginning of the year, the DMO has consistently taken more than it has offered to the market. Of course, that pretty much speaks to the fact that the market is awash with liquidity, owing from the fact that players can no longer, local investors can no longer, invest in the OMO auction. And so those monies, as they mature, are finding their way back into the DMO space for NTB as well as bond auction. So on the basis of that, yes, that would be the case.
So it looks like the DMO is also becoming aggressive with borrowings, given the revised borrowing plans for the government. Do you see that signaling the beginning of an upward trend in the Nigerian Treasury bills market?
As for signaling, it's something that will fall within the purview of the CBN. The DMO's job really is to, borrow on behalf of the government and at the best rates, possible. In terms of rate direction and then movement, really that's a call for the CBN to make. So if you say aggressive, the aggressiveness would be on the fact that my job is to borrow for the government. I see borrowings available at cheaper rate. It would make a lot of sense to take as much as you can take now.
Okay, so what's your view of the new bond auction calendar that sees an additional 105 billion naira to be borrowed monthly, while the figure for this month's auction remained untouched?
Okay, so the new calendar is just a reflection of the fact that there is a need to borrow, which has always been there. Part of that borrowing was supposed to be done locally, and the other part of it was to be done externally. With the issues that you have in the world market at the moment, it's difficult to borrow externally. So, it makes a lot of sense to then revert to borrowing that money locally. As for why the current one is left at 60 billion, while the others have been moved on, you would also appreciate the fact that between the time that the decision was made and finalized to convert the external borrowing to local borrowing, it were just days. And you'll expect the market to have time to be able to react. So it makes a lot of sense to leave the current calendar in terms of for the month, the way it is, and then prorate, far into the later part of the year in terms of what is expected.
Okay, so for talking about expectations, what are your expectations for the interest rates of all these borrowings? Let's start with next week's, auction.
Expectations in terms of where rates will go. It's a difficult call now. Things are really very fluid. For the DMO, if you go by what has happened in the past, they would be happy to borrow at maybe for the 30-year paper at 12.9, 12.8 downwards. Anything within that space, they'll be happy to take, in my opinion. Do I think anything will change significantly from where we had before? No. You would understand that you still have inflows coming from maturities in the OMO space that still don't have outlets. So for as long as those fresh inflows keep coming, you're likely to still have, that's liquidity glut, if you like, and as such, you would expect that things will still remain the way they are for a little while.
So PFAs constitute 51% of the existing bond market. Now, with this increased borrowing strategies of the government, do PFAs have enough to invest in government securities?
Okay, so I was doing a little review of the report by Pencom, and then I saw something in there in terms of where the PFA market as a whole, in terms of exposure to the government bonds and bills. And something was interesting that I found in there. You would see that there's about a compensating drop and gain.
Okay.
So where you have on a month-on-month basis, so if you go from the far right in this case, we'll be looking at what we have in terms of November, December, January, and February, which is the latest report from Pencom. You would find that on the global space, there's been a gradual increase and at some point a drop. So in December, there was an increase, and that increase was probably at the time where DMO did an auction, and we had an early Christmas gift. So there's a bit of uptick in there, and then it drops down. But it shows a bit more where you look at it from the treasury bills, angle of things, because the other one shows, the global position.
Okay.
On the treasury bills side, you find that month on month, there's been a sharp, drop about 2-3% on the average every month. And until the last one, where you have a drop in the exposure to the FGN space, you would look at what has happened in the exposure to money market instruments. It's a quantum 3% that has moved in 1 month to that space. And I thought that was instructive to show, to see where that movement is. But on a global level, which now directly answers your question in terms of where we see, what room is there for the PFA space. As at February, it was 67%.
Okay.
On the average, average now would mean you've taken the different types of funds because you have different exposure levels to FGN instrument. You're about 67%. What that means, or that tells me, is that there's probably about 3% room, to be able to, as new monies that can flow into that space. So, can we take more? Yes. Will it be so significant? Not too sure. And then that speaks to something else.
Okay, so with job losses as a result of COVID-19, a lot of people will be returning to their pension fund administrators, for withdrawals from their accounts. Now, with your investment in government securities, will there be enough to meet the demand?
Okay. In terms of job losses and coming to the PFS space in terms of being able to access their fund, remember that will take a 4-month period minimum. You will have to be out of work for that period to be able to access it. So if you take into consideration COVID, so March, you'll be looking at a July, August before you begin to see those
people coming to the market.
We would have enough money to be able to pay them. Certainly, yes. Except you're saying that we would have a total run. I'm not sure if China has dropped 25% of its
No, we
workforce.
haven't.
Exactly. So it's not like a total run. You have the asset is usually allocated appropriately as so as those demands come, we obviously can meet them.
Okay, so in the event that DMO is finding it difficult to raise interest rates, what will be the direction, the reaction of dealers rather?
I am okay. Help me out. Because DMO would not be raising rates.
Okay, that's
Is
the
that,
purview of
that's the
CBN.
CBN. So except if what you want to ask
So
is
if the CBN
does raise
does,
rates,
yes.
if DMO will find it difficult to be able to, access the market. I think the question at that point will be which is a greater need in terms of the amount to be raised or the cost at which, those amounts will be raised. I think at that point it becomes which is greater. But if you track back a few years before now, DMO was raising, bonds at 16% levels, 15% levels. We're far from there, right now. If you go back to the reason that the external borrowings have been converted to internal borrowings on a DMO, one of the things they've said is that they do not want to jeopardize, the smooth running of the Appropriation Act, to be able to do that. So that's probably a greater need. So if there is a push, if they're pushed to the wall and have to raise and borrow at a higher cost, I think it's something they will probably, consider.
Because do you see all these borrowings crowding out corporate bonds?
No, I don't. I don't because currently at the level that cost of funds are, it's not too prohibitive for the corporate world. So, I mean, we've seen 14, 15, 16 levels of borrowings in terms of costs now. If where we are, the premium to be paid on the current FGM for any corporate should be, I hope they don't take but it should be something that they can take.
Okay, but it also looks like corporates have been more interested in commercial papers than bonds. Am I wrong, or why is that so?
Well, I think that they're being pragmatic.
Okay.
So on your 1-year treasury bills, it's less than 4%. And as a corporate, to raise a commercial paper, you're expected to pay a premium on that. However, on your 5, 7, 10-year instrument, you're already in double digits. So if I am a corporate, if I can pay single digits to raise money to be able to deal with working capital cycle, I probably would do that. So the idea behind doing more of the CPs than the bonds may also be that, look, it's way cheaper to do one than the other. So why don't you just take that opportunity?
Okay, so, but with all of these borrowings, will there be any opportunities for retail investors?
There certainly will be. For I think in terms of the DMO does issue savings bond on a regular basis. That is still there. If the retailers do want to do that, I mean, there's also. I think today our discussion is basically on that, but the equities market is also there. So the retail investors have all of that available. So the opportunities are surely still there.
Okay, so just hold your thoughts. We'll continue with the conversation around Nigeria's debt market when we return from this. Stay with us. Welcome back, and thanks for staying with us on the program. Tony Odutola, the Deputy Head of Investment at ICO Pensions, is still with us. So just like we were talking about, let's talk about repatriations now. The FX reserves have improved lately. Is that enough for FPIs who are at risk of to repatriate their investments or dividends?
Okay, so the improvement in the FX reserves, I am not too certain that that's as a result of flow of FPI. If you recollect, of recent, we just got some credit alerts via the IMF, and I think we're still expecting some from the World Bank, ADB. So really, that's in my thoughts. That's where the bulk of that came from. So what components exactly made, that rise? If you also look at the volume of the increase, probably not as much as the actual credit that we got. So it tells you that there's been, a bit of that pressure in there. We are still a bit import dependent. So what's likely to happen is that when the import bills start to come in, you could still have a bit of pressure. But I think that the managers of the reserves have a bit of leeway to play around with because of the, income stream that they are still expecting to see. So I'm not very certain that it's actually FPIs that have done that.
Okay, but then, I mean, with these monies coming in, it could signal some pressure on the naira, wouldn't it? Or do you see a further adjustment in FX rates?
Further adjustments in FX rates is, again, that's almost a delicate thing. Delicate in the sense that it can be a bit political. But I think that of recent, what we found in terms of contracts down into 5 years, 60 months contracts that have been given has shown that what we are used to has sort of seen a shift. We're beginning to see about up to 470 in terms of the figures as it goes into the future. And what that tells me is, are we beginning to see a situation where we're saying, those will be the rates going forward? But what also means is that even for an FPI coming in, if you're coming in today, and I'm telling you that you'll have to go out at these levels, over a 5-year period, you probably lost 50% from that. And if you were to do a 5-year investment in the bond space at about 9% yield now, times 5 would be, 45. So there's a net loss somewhere. So something will have to give at some point. Will it be rates that would go up or the naira appreciate back? Something will have to give at some point.
Well, speaking about contracts, if we could just, drill more on that. Yesterday, we saw an upward review of FX rates at the FMDQ exchanges, FX markets, futures markets, especially at the medium and long term. So for the long-term contracts of 14 to 60 months, there were those were up by 7 naira 40 kobo. The shorter-term contract of 3 to 13 months rose by an average of 96 kobo, while the contract on the 1 to 2 month FX futures reversed by 24 kobo. So, what does that say? For investors trying to come in, what should they be expecting?
So, if I come in today and I come in at 380, if I have to go out, I would have to use the increase in there to buy. What that tells me is that, so I come in with my dollar, I get 380. To buy the same dollar back, if I have to do the contract, I have to use more naira. So that's a loss.
Okay.
Technically. All right? Just arithmetic, that's a loss. In other words, for that to make sense to me, it will mean that I must be seeing an asset that is very cheap, that can give me the upside to be able to cover for that loss. Okay. Now the question now would be, in all of frontiers and emerging markets, are there no other cheap assets that probably do not have this disconnect in terms of pricing of the currency? So we may need to be a bit more creative in the way we do this to be able to get that to flow back.
Okay, so any opportunities for UPFAs at the equities market?
There are always opportunities, diamonds in the rough, if you like. Maybe the names are not so many, but 1 or 2 opportunities you would find. I easily like to reduce this to what you can easily appreciate on a daily basis. So during this period, who are gainers? Gainers in the sense that which businesses are thriving. They may have their own challenges like any other person, but certainly there are certain businesses that are thriving right now. I'm sure a lot of data-based decisions are being done Zoom and all of that. So you have quite a bit of those things going on. Food is one of those things. So you will need to drill down and select. So it's no longer the case where you say the macro story is doing this, and so likely you find this, and then you can batch together, a few of those. Now you will have to do a bit more work and select those who actually are winners, and then you can place your bets.
But even with that, the market is very unpredictable. There's some companies that could be doing well, and then you're like, okay, so we can pick this, but then anything can happen and all of that. Because I mean, now we're seeing a lot of short-term investors in the market. So how will that affect?
I think averagely, Nigerians are short-term investors. Averagely, no apologies. You see that all of the time. But the reality is, for an investment professional, you probably need to have an understanding of what exactly you want to do. My boss would say things like, in all of the noise, place your eyes on exactly what it is that you would like to see, and then check the boxes. If what you like to see, this institution or this name, does check those boxes, then you place your bet. So you could find the oscillation, you could find those up and down movements, but at the end of the day, it comes to settle because the fundamentals were right. You've looked at revenue, you've looked at costs, you've looked at cost of funds, you looked at route to market, you looked at different things, and then you're sure that this guy does seem to have, ticked all of these boxes. So you could have, like you had in March, where the market just went all the way down and every stock went down. That could happen. What should it do to you? Probably give you the impetus to go ahead and stake more, all right? But at the end of the day, when the chips are down, people come back to say, okay, wait a minute. Just like we said earlier on, who are the winners in this space? And you just go there and stay.
Okay, so with COVID-19 and all the borrowings, a recession is looming and Nigeria is not left out. How can Nigeria balance these constraints?
COVID-19 and recession. Okay, the truth is this. COVID-19 seems to be a catalyst. Catalyst to, quicken something that was always there. Not a very good example to make, but we are told that the individuals who are at risk, more at risk with COVID-19, are those who have underlying, ailments. You can take that and apply on the nation. So we've had underlying issues before now, and then what COVID-19 has done is just to make those frailties show, quickly. The solution, if that is the right word to use, will be that those things that we need to deal with, which will be long-lasting solutions to these things, will be the things that we still have to deal with. So things like infrastructure, whether it is soft or hard infrastructure, and that's real funding, real funding. Of course, while you're doing that, you now have to deal with other issues like inflation, and all of those kind of things that seem to give you a bit of a pushback, because to raise funding to do those things that you want to do, you want rates to be low, which is a challenge that the government has. But inflation on one side, an investor says to you, my real return is negative. So those are the other challenges that you have to deal with. But there is no gainsaying that if you do not deal with your infrastructural needs, that issue will be there. Recession will come. If you're not careful, depression will come. But you need to face those core. Which of these infrastructure needs do you feel such that it has a ripple effect to help you, jumpstart the recovery?
Tony Otutola, the Deputy Head of Investment at ICO Pensions. Thank you for joining us on the program.
Thank you very much.
Well, that's it on the program tonight. Thank you for watching. I'm Edidiong Iwang. Remember to stay safe.